The Federal Reserve's recent messaging has reminded investors that interest rate cuts will not follow a predictable path. After delivering a second rate reduction in late October, lowering the benchmark rate by 0.25 percentage points to around 3.9%, officials quickly pushed back against expectations for another cut in December. Their comments signaled a shift toward data-driven decisions rather than a preset easing cycle. Markets reacted immediately, strengthening the dollar and pushing gold lower. This renewed uncertainty has redirected investor attention towards stocks with consistent cash flow, resilient balance sheets, and reliable income. In this environment, Merck and Duke Energy stand out as two of the safest high-yield dividend options. Each combines strong fundamentals with stable long-term earnings power, making them attractive amid shifting monetary policy expectations. Merck, discounted valuation and durable growth. Merck, a global pharmaceutical leader with a market value above $250 billion, offers a compelling blend of income and growth. Its forward dividend of $3.24 per share yields just over 3%, supported by a conservative 37% payout ratio. With shares trading near $103, Merck sits at only 12.1 times trailing earnings, well below sector averages, suggesting the stock remains undervalued relative to its growth profile. The company's latest quarterly results reinforce the strength behind its dividend. Revenue rose 4% year-over-year to $17.3 billion, driven primarily by Keytruda, which achieved double-digit sales growth and remains one of the world's top-selling cancer therapies. Additional contributions from Winrevair and Capvaxive highlight Merck's expanding portfolio, even as certain franchises like Gardasil softened. Earnings came in well above expectations, providing Merck with ample financial flexibility. Merck's strategic investments further strengthen its long-term outlook. Its $9.2 billion acquisition of Cidara Therapeutics targets a long-acting viral that could redefine seasonal flu prevention. Meanwhile, developments in its neurology pipeline, including Alzheimer's candidates with FDA Fast Track designation, position the company for future breakthroughs. Analysts forecast EPS growth approaching 20% next year and maintain a moderate buy rating, reflecting confidence in sustained performance and dividend safety. Duke Energy, regulated stability and infrastructure tailwinds. Duke Energy, one of the largest U.S. utilities, offers a higher forward yield of 3.44% through an annual dividend of $4.26 per share. Its payout ratio near 64% aligns with typical utility levels and reflects the stability inherent in regulated electricity and gas operations. At roughly $119 per share, Duke has delivered mid-single-digit annual gains and continues to benefit from predictable cash flows. The company's financial results demonstrate robust momentum. Revenue rose nearly 14% year-over-year to $8.3 billion, while net income surged more than 44%, indicating improving operational leverage. EPS of $1.81 topped estimates, and although next quarter's earnings are expected to dip slightly, full-year profits are projected to rise more than 7%. Crucially, Duke is investing heavily in grid modernization and infrastructure upgrades across high-growth regions such as North Carolina. These initiatives align the company with rising energy demand from population growth, advanced manufacturing, and data centers. Analysts also assign Duke a moderate buy rating with meaningful projected upside.